Well,
Okay.
welcome everybody to our Lunch and Learn. Today is Tuesday, June 8th, and we are very lucky to have Aloisi from Aloisi Associates talking to us today about how annuities may simplify your retirement. Al, take it away.
All right. Well, a little history about annuities. I do a little research and I went back to Roman times. Now everybody would say, well, wait a minute, Al, were you there? And no, I wasn't there. But that's just a little history. So show of hands, anybody have any annuities? If I can see them, well, you have, okay, good. No, none over there. Okay. So what is an annuity? Well, it's an insurance product. Now, while you have insurance that, let's say, is on your life, that benefit would go to the beneficiary. But annuity is a product that you use, and while you're alive, you get to enjoy the benefits of the growth and the gains. Okay, so everyone's situation is unique. We'll probably go a little bit more in detail on that. But so how do annuities work? You purchase an annuity by making a payment to the insurance company. And usually that's a lump sum. There are some annuities where you can add to it over time, and sometimes they overlap in the way the way underwriting and the calculations are made. But most of the time it's a lump sum investment. But annuities also appear in 401ks and their IRAs. And I'm going to talk a little bit about what happens with some that are in CDs and so on. Okay, so it is growing over time. You put that money in and it is growing over time. And it's growing tax deferred. So when you're ready to start receiving your retirement income, you have all different choices. You have a steady stream of income, and the income payments go to you. Now, Social Security is a type of annuity. You may or may not realize that, but yes, it is. It is similar to a life annuity, which means the payments go to you until death, and that's it. Once that happens, then it's over. So that's really like a life annuity. That's one of the types of annuities. So, but when you put the money in, a full amount is going in. A full amount of your money is invested, and some even have some bonuses up front, and which go to your benefit. Now, while there are internal charges and commissions paid, that does not come out of your initial investment. You do not. Everything goes in 100%. Internally, the investment is charged with different charges, but any commissions are come out of that, and then the other charges, but it's growing tax deferred. And during that accumulation period, which means you're not taking any scheduled payments, you can take some partials, you can take 10%, but annuities are different. They're not all the same. This is not a cookie cutter thing, because some carriers will say, oh no, you can only take interest only. Okay, and others will say, well, you can take 10% of your premium or your account after starting in the second year. So you do have some liquidity. It's the idea of the annuity though is primarily make that commitment if you can. It may not be in all of your assets in your portfolio, but maybe a piece of it that you want to ensure that the money is going to be there when you retire. So while you can take money out, it's in the form of partials as well. That is perfectly legal. If you are under 59 and a half, you could have a penalty though. So you want to try to keep that in there, until you're at least 59 and a half. So again, you do have access to some of the funds during that accumulation period. So There are several types of annuities. I'm reading from a chart, but it's you could have fixed annuity, immediate annuity, variable deferred, and fixed deferred, variable deferred. The bottom line is an immediate annuity is that you want to start receiving your income immediately. And so it becomes annuitized. Okay, deferred, it means that it's growing for your account, and it is growing tax deferred. And you decide when you want to take that stream of income. That is the deferred concept. Now, annuities can be in 401ks, and they also are in IRAs. But so you have that deferred tax without being in an annuity. That's true. The difference is that when you go to take your money out, then that's where your annuity kicks in, all different options. If you had a bunch of mutual funds and say, oh, wait a minute, I'm going to retire now. Oh, I think I'll sell this mutual fund. No, I'll sell that one. No, I'll sell this one. No, I'll sell that one. The point is, it's not automated. It's the annuity can be made to come out lifetime or a fixed period of time so that you enjoy your retirement income however you want to. Feel free to ask any questions along the way here. We're a small group, and it's perfectly all right. So all the different payment options are there. That life annuity means that, like we mentioned with the Social Security, the life annuity would mean that once you pass away, there's no more money in that account. That's the way Social Security works. But that's not used that often. That's a rare. It's more of a rare type of annuity that can be purchased. And then you can have life with a cash payment. There are life with term certain. That means you can have a lifetime payment, and there's a certain period of time that you will be guaranteed that income, and then after that it would be whatever the rate is after that. So you can have a fixed period that would be based on how much time you want that payment to be made, or you can have it in a lump sum and pay the taxes accordingly. So it would depend on the individual, what their situation is, and so on and so forth. You can also have a joint and survivor plan, which means two people can be on the same annuity. The fixed period would mean that the annuity depletes in a number of years. I'll tell you a couple of stories. This one would pertain to that. Someone close to me had funds, and they had to be in an assisted living home. So the money would deplete. We knew that. And I was able to take their funds and make it a 5-year payout. And that payout was coming in once a month, and that would pay for the assisted living home. And we're talking $6,000 to $7,000 a month, but we knew that was going to deplete. During that period, during that for that contract, we had named beneficiaries. That would be the siblings. And then when the payments were made, that was automatic. So the money came in, and you had the money to pay the assisted living home. So it was a 5-year plan, a 5-year contract. Aside from that, it's just assisted living homes and long-term care facilities. There's an average of a couple of years, 2.5 years or something like that for long-term care. But the woman passed after close to 2 years. The balance of the money that was in that annuity went to the beneficiaries, 4 siblings, divided up by 4, and that continued on until the 5-year period ended. That person was my mother-in-law. And the siblings, I believe, were happy. You might ask Nancy, see if they were happy about how it worked out. But anyway, the siblings did receive that monthly payment until the funds ran out. So that was just one story regarding how that fixed period works. So with an annuity, you're collecting when you live as well. So if you want to insure your retirement, I mean, you insure your car, right? Gilda, you insure your car, you insure your house. Time and homes, we insure a house, we home, a life, long-term care, and everything else. Okay, well, why don't you insure your retirement? And when you are in flexible, let me call it this way, flexible stocks, bonds, etc., there are fluctuations and there are downturns, but there are upswings as well. But with an annuity, you don't have that downside risk because even whatever you earn stays in your account. And if the following year everything is flat, the returns were flat, even zero or below, the annuity still retains its amount. It does not get affected.
I have a question.
Certainly.
How do they guarantee that? Is it insured federally? If you give them the money, they're investing the money to give you a return. If they make poor investments, how can they still guarantee your return?
Okay, because let's put it this way, because they can.
Okay.
Is it insured is another part of your question. Okay, and I was going to get to that, but I'll cover it now.
Sorry.
It's okay. No, it's okay. When you put your money into a bank, FDIC covers your CDs, your checking, whatever, and your savings. Okay, that's covered by the FDIC up to $250,000. Interesting enough, you do have guarantees in your annuities. Works different. It is insured by in our state, the New Jersey Guarantee Association. That's up to $100,000 before you annuitize. Okay. Every state has to have a minimum of $250,000 if you are annuitizing you're starting to take a steady stream of income. As you're taking a steady stream of income and you've committed to that, then New Jersey insures you up to $500,000. New York insures you up to $1 million, and the other states, mostly 90% of them are 250,000. One or two might be 300,000. But New Jersey is 500,000 once you start that commitment for the annuitizing your stream of income. Okay. This question?
You can have more than one annuity.
Oh yes. Oh, yeah. Someone's saying, can you have more than one annuity? Well, yes, Nancy said that. Behind every great man, there's a great woman.
Her hand. Hi, Nancy.
Bring me on the operation, Al.
Yeah. So yes, you can have more than one annuity. So that means if you have $200,000, let's say, and you really don't want to take it, and I'll tell you another story about another client. But you put up 200,000, you put 100,000 in one annuity and 100,000 in the other annuity, and you're okay. I mean, it's going to grow more in the annuity, so maybe a little over 100, but your liability is limited, or your loss is limited, and it very rarely happens because even another insurance carrier may take over an annuity if it goes into receivership or something like that, and that money would not be lost typically. I've never seen that happen. I've been in business 32 years. I've never seen that happen. And there are cases where if you, we would shop around, like Tamara or I would shop around for annuities. You would try to put somebody in A, maybe A minus, A plus, that type of annuity. They go by the ratings. But if you go into the B and the B plus and then the B minus, that kind of thing, you may get more of a return, but you may be taking more of a risk by going into that kind of a company. So you have to go by the ratings as well. So we're trying to ensure your retirement. Let's see what else. All right, so actually you have, you're going in with a contract. It's really a contract. And that means that you're committed to, let's say in quotes, committed to keep your money in the account and for a certain period of time. Could be 3 years, 5, 7, 10. It would depend on your age. It depends on whatever situation you're in. So that contract means that you're committed to do that. But that also means that the insurance carrier is committed to you, and they are going to watch your funds and keep keep that commitment, because they have to have a fixed payment over time. If it's a fixed annuity, if it's variable, then there are some extra charges in there, and sometimes there's more volatility, and you may or may not do as well. So really open for questions, I think. All right, so essentially you're putting money in, you're letting it grow or take it out immediately and convert it. So you go ahead, Gilda.
My question is, how young can you be when you start this kind of retirement planning? I was fortunate enough to work for a company in New York that started us out as ESOP, employee stock ownership. And at the time you had to be 25 in order to become eligible for that. Is it still that age?
Well, that, if it's for that type of product, if it's for that type of product, well, you can start an annuity at any age. I mean, that really doesn't matter. But generally speaking, it may not be all of your assets that you would put in it, but you can commit it to for a longer period of time, because you're not going to be thinking of taking it out soon. You can have a 10-year annuity. That's it. But you might start later in life, maybe 30s, 40s, something like that.
Yeah, I got a question. Just curious, and you might not be able to answer this, but I figured I'd ask.
If I can, maybe.
What type of like return on investment or typical average interest rates do you see?
Okay. All right. These are not high interest rates. The fixed, this is a very good question, because there's the other story I wanted to tell you about, and that is CDs right now. You might get 0.045%, less than 1%, and it's really, really low. I mean, so the one particular client I have, he had a bunch of his IRAs and some non-qualifieds in the money market and CDs. He was getting zilch. So that's one of the reasons why I'm putting that particular client into annuities, because that's what he wants to do. He's not that interested in real estate investments. He doesn't want to get involved with all that. He doesn't want to get involved with stocks and bonds. He doesn't want the variables. He's very, very conservative. And he has close to $4 million, and he does not want to do any gambling at all. So a lot of his funds have been coming to me for putting him in annuities, and in a variety of them. His CDs are paying barely anything. So answer to your question, Chris, the ones recently, I've put in some into at 2.5%, 2.60, 2.65, 3%, and that changes. You could talk to me about an annuity now, and a month from now, 6 weeks of 2 months from now, it would be different. And it depends on the value of money at that particular time frame.
Yeah, that answered my question. I appreciate it. Yeah, I mean, I would say you'd want at least to be matching inflation or higher. And
exactly, that's the point. Right? His CDs are, for example, the CD doesn't. It never does. He was making 13% on CDs way back when in the 80s. You still aren't keeping up with inflation. It's strange, because the banks aren't going to pay you more than.
I see. It's a great tool if you have a retirement fund that you don't want to risk losing in a more risky. Right. Okay.
Perfect. Yeah. You could roll over if someone's changing jobs, for example, or whatever, the situation changes, and now they want to take their money out of the company that they were in. And if they don't want to keep that 401k, they can convert it into an IRA, into an annuity. And then if they're ready to retire, then they can take the immediate income or let it defer a little longer. I see a question from Erika. Is that a question, Erika? You have your, oh, no, you were just waving at me. Okay.
Awesome. Thank you, Al.
Okay, that wasn't too bad. Let's see if I had any other points. So, what are we doing? What are you doing to?
Actually, Al, I do have a question.
Sure.
So you're an independent, right? So you're able to shop the marketplace for your annuity products?
Yes. Yep. Yep.
And
I deal with a particular annuity firm. In fact, now that you brought that up, I deal with a particular annuity brokerage firm that sends me spreadsheets on a dozen or more different annuities,
Mhm.
and all with varying ratings from A+ down to B-. And so I'm picking the ones that, you know, look better for the client. Some of them take a minimum of 10,000. Some of them need 20,000. So
Right.
all of these lateral and vertical combinations come on these spreadsheets. And I say, okay, this one looks like the one. Or the client will say, wait a minute, I don't want to put all my money in that one. I want to put some in here. So fine, no problem. Whatever the client needs, I can do it.
Got it. So you do both fixed and index. Do you do variable annuities as well?
No, I stopped doing variables because I gave up my Series 6.
Okay.
I'm only doing fixed index annuities and fixed.
Got it. And you do immediates as well?
Immediate, oh yes, immediate.
Okay.
Annuities. Yep, definitely. Yep. I've done a few of those. Yeah. So, let's see, what else? So in the fixed annuities, your principal and interest is guaranteed. Variable annuities, the principal or the interest is not guaranteed.
Mhm.
Okay, I think that helps answer the question. Okay, we covered some insurance. Maybe you're actually insuring it. And so you're committed to a time commitment, and we compared it to CDs. And yeah, that's one particular client I have been working very heavily for the last 6 months. He's, like I say, worth about, you know, a few million, and I'm moving him to all different annuities. So far it's 5 different annuities I have, some of the money going into, just because we want to make that separation. And I did it for his daughters as well, and whatever. So each carrier is insuring up to 100,000 for each person for the annuitized. Okay, does that help?
That's great. Thank you.
Okay, let's see what else. I don't really have too much more. Like I say, each person is different. Oh, there are surrender charges, and that would work on a sliding scale. If you pull out, if you have it, let's say you have a 10-year annuity, and you start, if you're taking out money at the beginning, in the first year, you could be taking 10%, you know, 10% or 9% was charge. You could have a surrender charge of 9%, then 8, 7, 6, 5, and so go on down the line until there are no charges at the end. That's why any commissions that are paid are expecting that the annuity is going to be kept intact. Okay, but like I say, if you're leaving it in there and you're making that commitment, that you're not affected by the commission over the long term of the contract. Okay, I can talk to you about commissions. Everybody here does commissions. Okay, any other questions? I'm trying to think if there's any other point I'd like to make. So like I say, everyone's situation is different, and going on to what Erika was saying before. Oh, also, for your protection or for the client's protection, there's a suitability test. Now that is has to be very precise, because for your protection, you have to, the insurance carriers look at it and they say, oh, wait a minute, you're putting too much over here, or this person is not qualified to do this, or it's you try to sell this to a homeless person or something, you know, that kind of thing. So there is a suitability test. It's very stringent. It's and that's just to make sure that nothing is askew. That's it. I don't think I have any other points I'd like to make. I'm really open again for questions, and there's no charge for consultation. Remember, I don't charge a fee for my services on anything, health insurance, you know, the life or annuities or whatever. It all comes out of whatever company we deal with. Okay. Anything else? Anybody?
This was great, Al.
I'd like to, if it's okay, Terese, I'd like to make a testimonial for Al.
Sure.
And the testimonial is this. When Michael left Columbia Bank, he retired from there, walked out. We had to go scramble for health insurance. And I have to say, we came to Al and we were fine. And I became a senior citizen over a year ago and became eligible for Medicare. I went to Al and it worked out beautifully. I didn't like the first company I was with, but I like the second company I'm now with because, and I think Terese, you mentioned this too, they offer coverage for dental.
Mhm.
People that are on Medicare still have to take care of their teeth. I mean, what they cover you for is 2 teeth, but at least you have. You gotta have a crown. You gotta have work, any kind of extensive work. It costs next to nothing. The rest is out of your pocket. So.
And older teeth have more problems than younger teeth.
And, you know, I once heard at a concert, a gentleman that was performing had said he was able to whistle because he had a very old tongue and some slightly younger teeth, and he's right. That's how it works. But the point is, your health and well-being are important, and you have to go to somebody that you trust.
Agreed.
So I owe, besides the testimonial, Al, in front of all these witnesses here, I owe you some fudge.
I'll take it.
Let's go. I want a picture. Share it at the perk.
Very good. Very good.
All right, Al, is there
Okay,
anything
is there
else?
any other questions? Somebody has any other, somebody they know, or, you know, I can always, you know, work out illustrations or anything else, whatever anybody needs. Like I said, it's like shop around, so.
All right. Well,
Okay.
Awesome.
thank you very much, Al, for your knowledge and expertise. I know you've been doing this for a long time and you know this in and out. So thank you for sharing it with us. And if there are no other questions, then I'm going to stop the recording.
John, Al.